Hey guys, welcome to the Limitless Podcast. I'm one of your hosts, Thaon Simms, and joining us as always is your co-host, Dr. Matthew Preston. Hail up the people and Matthew.
Hey guys, what's good?
Lovely. Today, as you guys can see from the title of this episode, we're going to be talking a little bit about concentration versus diversification. It's a topic that we've heard from we started investing, and we kind of just want to delve a little bit deeper. Right, Preston?
Yep.
Yeah, so
Yeah.
I'm
The
not sure
age-old
if you guys have
debate.
heard. Yeah, age-old debate. That is
Mhm.
true. Age-old debate of concentration versus
Which side are you
diversification.
for?
Me?
Mm-hmm.
I feel like we should save that for the end. But I feel like our listeners, if you guys know us, you know which side we are for. But it depends. It depends, and I'll elaborate a bit later. So, when we talk about concentration versus diversification, what do we mean? I guess we can split it. We can split. I don't know if you want to talk about concentration or if I should
Yeah,
talk about
sure. I'll
concentration.
talk about concentration.
All right,
So
shoot, bro.
essentially, when we're talking about concentration, we're focusing more on investing, right? So say, we focus more on stock investing. Say you have some money, you've been saving up your money, if you're, in school, lunch money, or maybe you have just got your first job and you're starting to get some income in, you're like, hey, I want to get into stocks. A lot of times, if you go to an advisor or whatever, they'll say, okay, these are the amount of stocks. And there are a lot of different companies listed. And the JSE, we're probably at almost like 100 companies. I'm going to actually even just share my screen. One sec. I think we are at probably like 100 companies or so right now. And if you're someone who's just getting started, you see it?
If I can see your screen,
Yeah.
yes, I can.
Yeah. So if you're someone who's just getting started, all of these different stocks you're seeing here are different companies that you can invest in. And you are probably like, hey, which one should I buy, or which of them should I buy? So you are trying to decide how much of them should you invest in. So you could invest technically in all of them if you wanted, or you could only invest in one. And so the different sides of the spectrum, one of them you're fully concentrated, fully dunce, some people might say, or you
Fully
are well
done.
diversified if you own every single stock. And there's like there's a debate about whether or not you should put all your money into one stock or just in a few carefully picked stocks, or the other side, diversification, if you should just spread out and put your money in a bunch of different stocks and just buy, and some of them will win, some of them will lose, but overall you're hoping to earn some money from it or win. So concentration is that you are trying to stay very focused. So the exact number, I guess, will differ for different people, maybe different asset classes like stocks, bonds, or maybe even just different age of the investors and things like that. So some people might say having one stock is concentrated. Some people might say two stocks. Some people might say even five stocks. Some people might even say 10 stocks. At the end of the day, there isn't like a set or a standard definition of, okay, this means you're concentrated. But I'd say most of the times, if you're probably putting like 2, 3 stocks, most people would probably say you're heavily concentrated.
So, what's the upside? Like, what are the pros for having, maybe one, two, three, like a very concentrated portfolio? What's the upside for that?
Yeah, so I mean, there are different pros. One of them I'd say is that, for example, you can, if you pick right, like if you pick the right stock, you can make more money possibly. So suppose, for example, um, let's see if my money JA can help. So over the last year, where is it? Yeah, over the last year, right? The stock with the highest gain was last D, right? Lasco Distributors, right?
Mm-hmm.
Suppose, for example, you were someone who was heavily diversified and you put some money, like you put 10% of your money in last D, but then you put, the rest of the money in some of these other stocks. So say you put it in First Rock USD, You put it in ECL, you put it in 1GS, you put it in ROC, Fosterich, all these different companies that are listed, right? Even though that one that you picked did really well, the
10%
that
of your portfolio.
10% that doubled 100%, all of the other stocks that you could have picked could have said these were the red stocks, the ones that have gone down over the last year. You may actually not, if only the one stock you picked went up and then all the others went down, you're not going to likely overall really make as much money as you could have if, for example, you had picked right and had picked, for example, last D or energy or transgem. So at the end of the day, if you pick right, concentration can actually help you get more money. But for example, if you pick wrong, and say, for example, you are concentrated, all your money was in MDS or even iCrates, you would, be down. So
Yeah.
concentration works. Like, I know, like, there's like a quote, I think Warren Buffett says that diversification is for people essentially who don't know what they're doing. So if you knew what you were doing, you would likely be heavily concentrated, because if you really maybe understand the business and the metrics of it and all that stuff, you'd be like, why would I put my money in anything else other than this company or these few
Well,
companies?
before I go into diversification,
The other thing I'd
Warren
say with
Buffett's actual
concentration,
quote was diversification is protection against ignorance. So it makes little sense if you know what you're doing. You get me? So and I guess when he says if you know what you're doing, in terms of, let's say you researched heavily last D, that has gone up 100% year to date, right? And you sat down for a couple of weeks and you research, and you did all of this, the research, and you know exactly where this company is going. You know that they're going to be super profitable, they're going to be paying dividends, this, that, whatever it is that caused the stock price to go up. And we're not going to talk about last D and why it actually went up in this episode. Let us know in the comments if you want us to, though, because we are going to be doing a stock review. We want to start doing just individual stocks where we review them on the channel. So if you guys want us to do that, leave a like on this and let us know which stocks you want us to review in the comments below. But Warren Buffett, when he said it makes little sense if you know what you're doing, talking about diversification, why diversify when you know, and not know, you can't always know, but if you have an inkling, or you're an educated guess, and you believe in this stock, right? And everything is pointing towards, all your research is pointing towards this stock actually hitting that goal and hitting your target of maybe 100%. Why diversify? So I think that's where he is saying. So diversification, yes, is protection against ignorance, but that's just the only way to mitigate that is heavy research. So I get the case for concentration in terms of the potential for higher returns, but also the potential, as you said, for heavy downsides. Because if all your money is concentrated into a couple of stocks and they all lose, right, that's a big problem. That's a huge risk, right? If those investments perform poorly. So there is heavy risk involved. I agree. I mean, Warren Buffett is known for concentrated investments. Also, don't you have you admire another local investor that's also very similar in mindset about concentration? You know who I'm talking about?
Oh yeah, let me.
You've
Chris
mentioned him
Berry
on the
and
podcast. Oh, no, also
yeah,
Chris Berry. Yeah, Chris Berry is one too, but that's not who I was talking about.
who?
I was talking about Michael Lee Chin.
Oh,
Yeah, see,
yeah,
you remember
definitely,
that? I don't remember
definitely.
which episode you said it on, but you said he put all his money in one stock,
Mhm.
and that one stock went up what, like 5x, 5 times?
Yeah, yeah. I don't remember actually
Yeah,
which stock, which company was it.
I'm trying to remember myself. I don't know if it was AIC. I'm trying to remember. I
No,
don't remember.
I think it's some Canadian, Mackenzie. In 1983, at 32, he
Mackenzie.
borrowed
Oh.
$500,000
Mm-hmm.
to purchase Mackenzie Financial stock. After 4 years, the stock appreciated sevenfold. He used the
Sevenfold.
profits to make his first acquisition, which was AIC.
There we go. Yeah. Yeah. So that's another great local example and the upside for concentration. But of course, we know the downside. But before we go into more of that, I want to talk about diversification. So, that's just spreading your investments across, well, if we're talking stocks, of course, across various stocks. So you see that exhaustive list of stocks that's on the market. I don't know if you've ever, you know, uh, spoken to a broker, somebody that works at a brokerage house, and they say you must invest in like these 20 stocks or these 10 stocks or so on. That was my initial when I first made my account and so on. And I had an advisor. They advised me to invest in maybe about 10 different blue chip stocks. Um, just to
Remember
spread
which
your
ones?
investment. No, I don't remember. I remember GK was thrown in there.
GK,
I remember
Wisynco,
Seprod, NCB,
Broilers.
Broilers was in it too. Yeah,
Um,
Wisynco's definitely in it as well. Um, this is when NCB was like
Kingston
200.
Wharfs.
Yeah, Kingston. I think Kingston Wars was in it. I can't recall if Kingston Wars was in it. I think so. Yeah. So I mean, when I just started, the the conversation I had with the broker, and it was just to mitigate. It was risk management basically, because they would say things like, "Oh, don't put all your eggs in one basket," because it does help reduce the risk, but it also, as Preston
Wait,
showed you,
it can help. Hold on, it
it can
can
help.
help to
No,
reduce
no,
the
it
risk. It
can
doesn't.
help.
It doesn't
Yeah,
always, because at the end of the day, you could could spread it out, and all 10 of them could go down.
very true. Very, very true. Good interjection.
Yeah.
It can help. It definitely can help, but if you're, as you say, not doing the proper research or so on, it can also be terrible, and it can water down the gains that you would have made if you had maybe one or two good eggs and eight bad eggs if you were just investing in 10 different things. And it's also not just stocks. You can also diversify your entire portfolio by investing in different asset classes too. When I started out, I had stocks, I had unit trusts as well, right? There are people that were telling me to get bonds. Never have bond money them time. get bonds, and now as I'm older, a lot of people I know are buying their first home. That's an investment, right? Buying properties, buying apartments, and so on. So that is still also diversification. You're diversifying your portfolio. And I never knock diversification, especially, or I should say only when my companies diversify their revenue streams. So I'll I like diversification in that standpoint, meaning I don't want to use GMT. I'm trying to find a great example on the Jamaica Stock Exchange for
Wait, great
good
example of what?
diversification of revenue streams.
Oh,
So our companies actually diversify how they make money, so that in case
maybe
there is a
GK.
part, GK is great.
You don't think
GK is a
GK could
great
be a good
example,
example?
right?
Yeah.
Because they have two major divisions: it's financial division and their food division. So they make money from selling their products, which is the food products, I should say, and also financial products and services. Western Union, their own First Global, they have an investment portfolio and they're bringing a lot of companies to market and so on the financial side as well. So they do diversify their revenue stream. So in case one aspect is hit, right, then, it doesn't look as bad in terms of their revenues because they have a ton of other revenue streams. For me, if we're talking about diversification like that, that's great. Love that. Love that. But if I
So look at,
personally
for
just
example, this is
shoot.
oops.
No, go ahead, bro.
Look at GK here. This
Mm-hmm.
is their report. The 3 months ended March 2024. You can see they actually break down the different segments. Excuse me. So they have food. You see revenues here. They made like what 34. What's this? 34 billion Jamaican revenue, and they made like almost 2.3 billion in profit from food. Then they have the other side, banking and investments. I made about 200 million, insurance, 300 70 million. Money services, that's like the Western Union and stuff like that. So you can say that, for example, their food side really is helping them. But even though, okay, yeah, they have the insurance and stuff side, their main profit maker right now is food. So if, for example, GK had just said, hey, let's only just do this investing or finance side, they could have thrown away this possible profit. But as you were pointing out that before, it doesn't always have to work, because an
Yeah, it
example
doesn't. It
that I'd
really doesn't
say,
always work at all.
could think about, you know which company I'm gonna say?
I don't think it's necessarily Jam Tea.
No, it was just Jam Tea.
Okay.
Hold on. If you look at Jam Tea, for example, let's see their reports. What they have said essentially, so Jam Tea, essentially Jamaican teas, if most people you guys don't know, the Caribbean Dreams, Tetley, teas, they manufacture those and distribute those. They have a manufacturing and distribution side, then they have a
Real estate.
investment arm, and then they have a real estate. The real estate side is HMA Food and Sons. So, for example, they mentioned, trying to find where, I think it was in this report they said it.
They didn't break down revenue in the actual financials in this.
Yeah, but I think they
do
spoke
in
about
their audited. I'd have to double check.
Reduction in because there's a, I think it was a report where they actually mentioned that they're essentially going to be, they're trying to sell the properties. Oh no, this is the same one. They're trying to sell the properties that they developed essentially at cost, and then they're going to essentially get out of real estate. Or was it in an article?
I'm not sure. I remember them saying that they are getting out of real estate, which should make them pretty cashy, but at cost is that's a lot of time, kind of, I guess, wasted.
So yeah, because one of the things I was thinking about is,
but that's them concentrating.
Yeah, what if they had, because they've been in this real estate thing for several years. It's not the first project they've done. They've tried to do multiple projects. Maybe I think some might have worked, and then I think probably the last few ones have really done so well. What if they had stopped doing that 3-5 years ago and had just doubled down on the manufacturing side?
Exactly. Or even performed better in the investing side. Yeah.
But one of the things we could even do is mention some local companies that, okay, an example of concentration with a local company that has their stock portfolio very concentrated is MJE or Mayberry. So let's
depends on what you call very concentrated, but agreed to some extent.
So
because they own quite a few companies.
So if anyone doesn't know, Mayberry, the investment bank, they have a stock portfolio that they manage, which is Mayberry Jamaican Equities. That stock portfolio is listed, and you can buy shares in that company that owns the stocks. So this is the report, which is up to March 2024. They actually break down, you see the top 10 largest holdings as at March 2024. And this is the percentage of the total value of investments. SVL or Supreme Ventures, everyone knows, like Scratchers, Cashpot. That is essentially half of their portfolio, or more than half of their portfolio, 52%.
Yeah.
And then CPJ, that's 9% of their portfolio. JBG, that's 8%. Wigton is almost at 5%. So you can see that they are heavily concentrated. And they were even actually more concentrated before, because look at this, March last year, SVL was 60%. I guess technically the thing is that SVL share price has likely dropped since then, so that's part of it. I don't think it's that they've actually, pretty sure they haven't sold shares. Yeah, they probably, if anything, they either maintain it or bought more. But they're very heavily concentrated. More than half of their portfolio is in a single stock. But then look at something like QWI, which is essentially Jam T's stock portfolio. where is it? I don't think they break it down. Oh no, that's.
Preston?
I don't think they. Yeah, you hear me?
Yeah, I can hear you. Sorry.
I don't think they break it down.
I like that. I don't think
Yeah,
so
they don't
either.
break it down like this. And the thing is that they are also in the US market.
Mm-hmm.
And I guess I'd have to it would be nice if they put the US value and the Jamaican value so
Icon
you could
value.
I feel like the
Compare
graph.
properly.
You don't think they could have some nicer bro, what is this image? Can't we get no high definition image, bro?
Call up Sir John Jackson.
You don't feel like they
It
could
could be
have a
better.
nicer.
I think
Yeah,
a
it's
lot of the
2024,
the
guys.
standard is pretty low in
I
our
mean,
market.
at least you can copy. Remember, there are times where like you can't even copy from the report.
Yeah.
But yeah, essentially, if you look, but the thing is, they don't tell you what their whole portfolio. They just said top 10 largest listing.
Holdings,
They don't tell you a
yeah.
percentage. But you can see, well, so they have Access Financial. That's what 186 mil. They're heavy in Dolphin Cove, CPJ also, but they don't. I wish they kind of broke down like a percentage and things like that. But they aren't as heavily concentrated as, for example, Mayberry Jamaican Equities or MJE.
Yeah.
I guess at the end of the day, you can see
even
what the
internationally
returns
too.
too, because
Internationally, you can tell like for Warren Buffett, since we're talking about him, and Berkshire Hathaway. Berkshire Hathaway was also pretty concentrated because I think about 40% of their portfolio, isn't even this year was Apple, right? That was a significant percentage. It was almost close to $150 billion worth, right? US. It's maybe 130 odd or 140 odd billion. I don't remember the actual figures, but it was a huge, huge stake in Apple. So they were pretty concentrated, and then I had other stuff like Bank of America, Coca-Cola, those other stakes, but I think American Express is up there too.
Oh, I found it. So this article came out this year. Oh, wait. Today, wow. So see, they actually cut in the first quarter this year. Buffett actually cut his Apple and Paramount Global stakes. Sold 100 million shares of Apple in Q1. It says with 13% cut. Wow. Okay, interesting. But it still is one of their largest.
Most cash that they've ever had, actually. Berkshire Hathaway. They're sitting on the most cash ever. So, don't know what they're gonna
Bank
do.
of America is actually their largest.
Wow.
Their largest position now.
Wow. 1 billion.
You know something interesting? I remember reading. I think there was like an article recently. Do you know what Buffett's dividend yield is on Coca-Cola? Apparently.
No. He was buying from.
I was told it was like 60%.
Wow.
Yeah, look at that.
Yeah.
See this? Warren Buffett is now earning this is May, a nearly 60% yield on Coca-Cola.
Jeez.
Wow. Imagine, Can you imagine you buy a stock and you get back half your money? I'm guessing this is an annual yield. And I don't know how often they pay dividends, but say they pay dividends once every quarter. You put money down and you get dividends almost half of what you put in. Wow.
Yeah, per year. That's a beautiful
goals,
investment. Goals indeed.
Goals, yeah.
I don't even want to calculate what the actual dollar value is for that Coca-Cola dividend. But
because this is saying, if this is true, 400 mil.
Wow. Per dividend. Per year,
over
I guess.
200 million per. Wow, that's.
Yeah. He's built.
But yeah, I mean, to each his own, though.
Yeah, true.
You don't think to each his own, because like at the end of the day, one of the things I wanted to say about the concentration, one of the pros of concentration, I'd say, is that, like, okay, say for example, we're still talking about MJE, right? MJE, half of their portfolio is or slightly more than half of their portfolio is SVL, Supreme Ventures, right?
Yeah.
So essentially, they need to know the gambling business, right? when you focus on certain things, you can kind of do more research on it.
Oh, I get where
So,
you're
or it
getting at.
encourages, I guess, you to do more research. So, like, for example, if you have 10 different stocks,
Mm-hmm.
or say Mayberry took the approach of owning almost, what about, I think we said like 100 different companies on a JSE. Imagine understanding all of those businesses really well, to understand like what's going on with them, what are the macroeconomic factors, talking to the managers, doing all of that, reading through those reports,
Mm-hmm.
looking at the different laws that the government is putting out. That's way more work. Like, imagine them doing that for all 100 companies listed on the JSE. Like, that's a lot of work versus they can kind of buckle down. They can do some light analysis on all of them and say, okay, these we think are the best.
Yeah.
And then like they can there focus more. Okay, these best I think are the best, and you can kind of focus more down, and then kind of focus on that business.
Yeah.
But
I
like, if
personally
you
don't
have
know
10 different
anyone
companies, how
that,
can you keep up?
yeah, I don't know anyone that has like at least 10 companies and knows
Mm-hmm.
enough or what I think they should know about each one of them.
Mm-hmm.
Right. And it's hard to keep up with
Mm-hmm.
all of those investments unless that's
Mm-hmm.
literally what you do and that's your, that's your day to day, that's your job. Fine. But if it's just like me and I just doing it on the side, and I have 10, 15 different companies in my portfolio, I can't keep up with the news on all of those and the news on companies that are related to those companies. And as you said, the laws, the things that change, how did the prime minister's budget, they're allocated more to education and those kind of stuff. Is Learn gonna get more money? Is one gonna get more money? How does that trickle down? And you have to be watching every single thing for all 15. When if you had like 4, 3, even, you just know that you're watching these baskets carefully. All your, you know, all your eggs aren't necessarily in one basket. They could be in 2 or 3, but you just watch them like a hawk. Right? You pad them up, you protect those baskets instead of juggling 10 different baskets. You have one bound to drop.
So like, if you even think about the argument of, say you're someone, you're just getting into this, and you don't have, say you also have a job, and you don't have a lot of time to be able to read up on multiple different companies, read all the different earnings and things like that. It might help you to kind of just do maybe one company at a time, do the research and
Mm-hmm.
truly understand. Because at the end of the day, one of the things that really helps you, like, as much, this is investing, there's always going to be risk, but you are trying to reduce your risk to a point that you feel more comfortable investing your money.
Yeah.
And what helps to reduce that risk is like understanding the actual like fundamentals of the company, how it makes money. Because at the end of the day, if the company is not making money, it's not gonna really perform well. So you need to understand how they make money, and you need to be able to research on that. So that's one of the pros, I'd say, or yeah, one of the pros or four reasons that I am more for being somewhat concentrated.
Mm-hmm. I would say even, well, I guess maybe, I don't know if it's maybe a pro or a reason for diversification. Also depends on,
Mm.
as I say, you and what you're managing. Because suppose you're managing other people's money, right? Suppose you have a multi-million-dollar portfolio that you're managing, right? You have to now answer to investors. You have to answer to all these different people. That concentrated approach may not be the best approach, because it may be seen as super risky. And then if a lot of investors see you, can you imagine? Have you watched that movie, The Big Short?
Mm-hmm.
I think that's what it's called, The Big Short, with the
Yeah, I watched it.
the housing
Ryan
crisis.
Gosling.
Yeah, who was that?
What's his name?
There's the autistic guy,
Christian Bale.
Christian Bale. Was he the autistic guy basically he was in charge of other people's portfolio. I remember watching that movie and people,
Michael Burry,
yes, Michael Burry,
the main.
and he's the one that
Oh.
said, "Yo, I'm gonna short all of these companies." That was risky. He knew what he was doing, yes, but
Mm-hmm.
that was risky, and a lot of people, investors, were calling down his phone, said, "Yo, what the hell are you doing with my money?" and so on. In that point, at that point, when you have to answer to so many different people, and you have to, it's and I think they would use the whole term of fiduciary responsibility to not overly concentrate those kind of portfolios, because
But at the
even
end of the
getting
day, that'd
out
be
too
more
might be hard.
their tolerance. Yeah, that'd be definitely.
Yeah. So it
But
all
the thing is
depends.
also with him having a lot of different companies, like say for example he went the other route and he is like in the 50 different companies, and then he has the answer to the investors, and then one investors at their shareholder meeting is like, hey, could you tell me about what you think about this latest thing or what the government says about this? And then he's like, oh, I don't know,
Mm-hmm.
because like he just is so busy, and that looks bad too because they'll be like, hey, but there's 10% of our portfolio in this or 5%.
Well, I
Like,
feel
how,
like
why don't you know about this?
if it's 10% or
No, but
5%, he should know
but
about it.
it's still your money.
No,
What?
no, I
No, but
agree.
that's my problem is
Yeah.
my thing is like, because you're once again the same point, because you're then spreading yourself thin, you have to know a lot about these different things. You might miss
Yeah,
things.
but that's his
It's a
whole
lot easier
job.
to miss like one notice.
That's his
I
whole
know, but
job.
you still can miss things though. Even if it's your whole job, how are you supposed to know everything about all these different
He's just
companies?
supposed to, bro, because you have my money. If you're managing my money and even 5% of a multi-million-dollar portfolio is a lot of money, right? So even if your investment is five, look at Mayberry. Wigton was 4.5% of their portfolio. You think them don't know everything about Wigton? Them know everything about Wigton. Maybe not so much Lasef, and I guarantee they probably do know about Lasef. Don't know why they still hold detail, but hey, I'm just saying, like, though, if it's that significant portion, fair. I understand what you're saying though. If it's 50
I mean,
different
they're dumping it
companies,
though.
yeah, they've
You don't
been.
see this
Chris been dumping. We're top five
400,
disposals detail. He is
435.
still selling.
You have a lot more to sell.
Wow, Chris Berry is still selling detail. I remember when he used to tweet about that. He used to
Mhm.
tweet about how bad detail is performing and them doing the whole APO, and yeah, he was an avid avid. I wouldn't say hater. That's not the right word, but yeah, you can tell if you don't like something, them just sell it. Just like in our previous episode when we spoke about carb cement, he just sold it. So yeah, interesting to see though. But I understand your point. It is hard to keep track of all of them, but if it's your job, it's just your job. It's your job. It's just your job. If this is what you're being paid to do, right, then just don't invest in 50. Invest in 25. Invest in 30 where you can manage because you're managing people money.
Job of a portfolio manager.
You have to
It's
balance
quite
the
a tough
risk.
job, yo.
Yeah, and expectations, all of that has to be. It's a tough job.
You think you'd ever do it?
Yeah. Why not? I would just select people. So it would just be so. Wouldn't select people. Let me think about this. I would do it, yes, but the people that invest have to. No, I can't even say they have to understand my investment
You'd want
style.
certain clauses or them to like sign certain agreements.
Yes, but it's not even just to cover myself. They just have to know that if they want to get rich, this is the strategy, right? Like it depends. I would have to at least tell them and temper their expectations. Meaning, if this is the strategy, if we're trying to go up 20% for this portfolio, just know that this is quote unquote high risk, and like you have to communicate with people and ensure that they understand expectations and so on. That's the biggest thing in managing people's money: communication, managing expectations, managing risk. Uh, in my opinion, as I said, just a doctor, but if I were managing a portfolio, that's literally what I would do. And of course, I'd go big. And it depends on the type of portfolio. Is it somebody's pensions? Because if it's pensions, I have to invest differently, right? You have to look at it. All depends on the type of people that you're invest. If it's young people and so on, and that's a high risk, and then more 100% in 1 year, and so you have to manage. You have to, treat that portfolio differently. And if it was like, you know, people about to retire and things like that. So it depends, because I've always thought about being a manager, a fund manager for doctors specifically, or nurses specific, or just people in the healthcare industry specifically. You know, that's always been something in the back of my mind, and maybe we'll take up one day. I'd have to do a lot more work, a lot more research, get some certifications under my belt, and hire the greatest of people, the best people, sorry, the best talents, I should say. But it's something I've always considered. Would you do it?
Maybe. I definitely similar points to you where I'd have to make sure that there's certain clauses in place. Like I wouldn't want a situation where, because at the end of the day, sometimes with the market, you can be right about something, but
Mm-hmm.
you know, maybe the payout time that you expected, like, okay, you expected it to be good in a year, but the stock is down right now, but you know that, okay, in this amount of time, it's likely going to recover. But then suppose the person's like, nope, I don't trust you. I just want to sell. And then you realize a loss. And then in a few months, it's shot up 50%, you know?
Mm-hmm.
Um, and but yeah, so I think I would, but it definitely has to be with the right people.
Yeah. Yeah.
Yeah.
Yeah. Um, I
It'd be
get.
interesting to do like some big money plays. Like imagine 100 million
Yeah.
or like 100, like a million US portfolio. Like what you could do that, you know?
Exactly. Yeah. If you're getting to those leagues on our market too in the JSE, it would be crazy. Actually, we'd go crazy. It would actually be very fun. I'm not gonna lie.
You could be the wall they're talking about in the groups.
Yeah. Yeah. Or you could be that big iceberg by order. you know.
Yeah.
Um.
Are there any walls that you know about now?
And actually, don't really watch the cues like that anymore. I used to, and I guess maybe for some stocks I still do, but not generally. Not generally anymore. Yeah. But even as that kind
But
of
yeah,
manager, you have to watch. Even there's so many things you have to be doing because even when we talk about concentration and diversification, you could even be diversified in terms of the amount of stocks, but not necessarily the type of stocks. And you could be concentrated. Imagine,
or
imagine
like
like
industry.
yeah, imagine like in the remember back in the late 90s, right? Well, we weren't born yet, but in the late 90s, there was this whole they call it the dot-com bubble, where the internet got super popular and there's like a lot of tech companies going
Yeah,
public.
I'm actually reading a book that talks a lot about that. Like some of the things it was talking about is
Mm-hmm.
crazy.
What's the book
Can't
called?
remember the name. I think it's a random walk down Wall Street. I think it's yeah. But essentially, some of the things that happened, I didn't know this happened. Apparently, there were companies sometimes that were listing
Pre-revenue.
that not yeah. Some of them didn't even have any revenues.
Yeah, I remember.
Yeah, I
I
think it's
I
this
read
one.
some stuff too.
And there are companies where you say you had a company and imagine us like to a Jamaican example. Say there's Honeybun, right?
Mm-hmm.
And you have Honeybun. Honeybun is doing its stuff, and then Honeybun just changed its name to Honbuntronics,
Mm-hmm.
and then the stock price just shoots up 150%. No increased revenues, no increased profits.
Yeah,
There were companies that were doing that,
that's
where
great.
all they would do is just change their name to something with tech
Yeah,
and things like that, and their stock price would just shoot up crazy amounts.
mm.
Like it was
And that's what caused that
just
whole
wow.
what they call the dot-com bubble, right? And at that
Mm-hmm.
point, I remember reading like early 2000s, maybe 2000 itself, maybe 2001.
Mm-hmm.
I don't remember, but that bubble burst. And when that bubble burst, that stock market fell. The
I know
whole
there was one
Nasdaq fell
pet.com.
almost like 80%. What?
There was one, I think, pets.com or something like that.
Pets.com. Oh, yeah, yo.
They had some similar to that where like it was pets.com.
Mm-hmm.
Yeah, see why did pets that I think they like didn't have I think it's a similar thing where just company wasn't earning doing anything and but people were just super
Investing?
excited
Yeah,
about it. Uh,
crazy.
Even something that was interesting. Do you know well, yeah, you must know Mark Cuban.
Yes. Shark.
So Mark Cuban, yeah, Shark from same Shark Tank. Big up Shark Tank.
Mm-hmm.
He had founded a company. I don't remember the name of it. It was like an IT company, and the company was doing really well, and he sold his company for like billion or whatever. That's how he essentially became a billionaire, right? And I think part of the deal was cash, but part of the deal, he sold it to Yahoo, by the way.
Okay.
Part of the deal was through Yahoo stock. So Yahoo did some cash and bought his company, but they also um, sold some of their stock or exchanged some of the shares in that company for the Yahoo stock. And so he owned a significant portion of Yahoo,
Mm-hmm.
which was worth a lot of money. Him and his, I think, the other people that he did the company with. And Yahoo was part of that essentially internet bubble. But something that he did interestingly, he did something where he had like an option that essentially protected his downside so that if the price, it was like a, let me see, I think he had the option to essentially sell at a future price
Mm-hmm.
that would be lower than the price of Yahoo now. So say the price was $30, he's saying, okay, I'm willing to pay this option to be able to sell the, I think at like $25 in case it were to crash down to maybe $20 or something like that. And essentially that happened. And then he was able to essentially stop a huge loss
Oh.
and save his wealth. But if he hadn't done that, he would have lost like almost all his money or a significant portion of his money. I wonder if I can find the exact. I hope I explained that right. If I didn't explain it right, guys, please drop in the comments. But yeah.
Mark Cuban. That's a brilliant move. I wish our
Yeah.
market had things like that because I would know more about them, like stock options and so on, calls, all of it. Yeah. Oh, I
You
see.
see, this article saved us $1.4 billion.
Wow, 1.4 billion in 1999 would have been a ton
So he
of
put
money.
options to protect his downside. Sold call options to offset the cost of the puts. My
Uh,
hedge worked out perfectly. Uh-huh.
Interesting.
Yeah.
I'm gonna have to read it afterwards. But yeah.
He's a brilliant guy, you know. There's a podcast that I watched with him. Who was it? Lex Friedman.
Yes, Lex Friedman.
That was a really good episode. I definitely recommend that.
Okay.
He's a very smart guy. Definitely, he does his research. Or he does his research.
Okay.
Mm-hmm.
Well, that's
Yeah.
that's all I have to say on the matter. I don't really have anything else I wanted to say on concentration versus diversification. Anything else you wanted to leave the people with?
No, I mean, at the end of the day, I think, you know, just like almost anything in life, there's a lot of times you shouldn't really go to the extreme necessarily.
Mm-hmm.
So I'm not telling most people to just put their money in as a single stock or put their money in maybe 50 stocks or whatever. Like those are the extremes. I think there's a balance that most people ideally should strike. And
Almost
at
like
the
a
end of the day,
hybrid
some people
approach.
should. Yeah. So at the end of the day, you need to decide whether or not you are shifted more to the concentration side. And maybe it could change even. Like at one point, you may be like, okay, based on what I'm seeing in the market now, the options, I think most of my money should go towards this. And then you could lean more to the concentration side. And then, okay, now I'm changing. It should go more towards this.
Mm-hmm.
Maybe as you go throughout your life, whatever different circumstances.
Mm-hmm.
So I don't think it's just a single thing, just only ever own one stock, only ever own one stock, only ever own 50 stocks, only ever, there's a balance.
Yeah.
So it's really just you finding that balance.
And it's for you too. It's based on your risk tolerance as well. Because to you, one stock might be fine. Like you might be able to sleep at night with all your money in one stock. But for me,
You ever did
that's
that?
one stock. No, never. The
Never in your life?
I mean, when
Not
I
even like
just
when you just
started,
started
of
out?
course, yeah, I had
Yes,
all my
so you
money
have
wigged
done
up.
it.
Okay, but that was an IPO, and I never knew what I was doing.
So as in since the IPO, you haven't done it?
One stock? No, never. The least I've done is two stocks. The least I've done is two stocks, and even two stocks, sometimes I find it hard for sleep at night. It depends on the two stocks. So now three stocks is good enough for me. I can still probably do two stocks depending. If it is one stock, bro, that one stock I would have for the research so till I know what's gonna come. Like I'll see what possible deals can be lined up and what chatter is from sifting through the Gleaner articles and everything and figure out something that no one else can see, right? Just from looking through articles and proper research and so on. And then I'd say, all right, it is inevitable. This thing has to be so inevitable where I can put all my money in that one stock. But currently, I haven't seen anything like that to just sell everything and put it in just one stock. So I have not done that. However, right, if your risk appetite is that great, if you have a high risk tolerance, then why not? But you're right. The different strategies are for different investor profiles, the investment horizons, your personal financial goals, so the short term, long term, all of those kind of stuff, right? The risk that you're trying to manage and so on. It's your money or somebody else's money. It all depends. It all depends. But I agree with you. We shouldn't do extremes per se, but just to balance both. And I call it, there are some elements of concentration that I like. There are some elements of diversification that I like. Like, let's say I had two stocks, right? That is concentration. Nobody can tell me otherwise. However, it can be more concentrated if those two stocks are in the same industry and their two stocks are very related. Let's say it was like NCB and Scotia, but both are performing very differently right now. However,
Or NCB and
or
Guardian.
NCB and Guardian, which
Mhm.
are two very related companies. Or you could just have a diversified approach, like a NCB and a Honey Bun. That's made market, junior market. That's two different industries. So it's still that's still a hybrid approach. But because financial stocks could be booming and you just want to offset possible risk of it, failing, or that one company failing, by diversifying and having a second company. But as I said, it's all just a balance. It all depends on, your goals and your risk tolerance. So just invest wisely. And if you can't do it on your own, there are licensed financial advisors that are out there to help you. Big up Danai Hall. Don't really know any other independent ones, but you should reach out to your broker specifically if you guys have any advice, because for us right now, this is not financial advice. It's just us having fun and chatting on YouTube. So thank you guys so much for another episode. If you guys like this episode, leave a like. Drop some comments if you want us to actually go into the stock review series that we want to do, and just tell us your stocks.
Let us know, guys, which stocks you want us to review.
Because your comments will
We're hoping to
actually
start
go
it
into a
soon.
database, and it's some
And
stocks
what
we'll
you
think
guys can
about.
do is like, if you're listening on YouTube, if you see someone that's posted a stock that you like, you can just like that comment to show us that, okay, I really want you guys, and whichever one I guess gets the highest vote. Or maybe what we'll do is even maybe put a link or something where you can like vote.
Yeah.
We'll see. But yeah, just tell us which ones you want to review.
Thank you guys so much for listening again.
Yeah.
Have a great day. Limitless out.
Peace out.